banks are actually alive. And what they're doing is they actually provide lending to one another so that that bank can actually be balanced at the end of the day. So that's what the overnight lending rate is, actually the bank rate that they charge one another for funds. So that's not our interest rate. Prime is 5.20. I don't think it'll go down as low as 3, but that's all speculation. But that's actually how banks communicate, and that's what that 3% is. So don't confuse that for what you would get on your mortgage.
Yeah.
At least not yet anyway. Okay, awesome. Okay, beautiful. So let's just jump right in, folks. So firstly, thank you for joining us. I'm honestly, very excited for the opportunity to partner with the Roar Group and Richard and his team on essentially a first-time home buyers master class. My name is Mac Phillips, and I'm a mortgage broker. What we're going to be doing today is going over some really exciting and creative ways to increase your down payment and just make sure that you are successful as a first-time home buyer. We're going to introduce one another on the next slide, but just really thankful that everyone is able to make it out this evening. And what we're going to be doing is spending about 40 minutes in conversation and then leave sufficient time at the end to handle any one-on-one conversations and questions. Feel free to raise your hand or unmute at the end once we get to that stage. So today's agenda. So firstly, we're going to give you some really cool information on how to increase your down payment. Often first-time home buyers, that's the number one pain point is I've got good income, I have good credit, but how in the heck do I get my down payment? And we'll tell you exactly how to do that today. We're going to talk about what's new and exciting in the world of first-time home buyers, all the new incentives that have been put in place to help you qualify, a step-by-step guide, literally from pre-approval right to move-in day. And we're all going to also be talking about how to time the market. When do we buy? What do we look at? How do we decide when it's a good time to get into the market? Okay. And allow my colleague Richard to introduce himself.
Okay, yeah, thank you, Mark. Yes, my name is Richard Oyekunle. I'm a real estate agent. We cover GTA and surroundings. We go as far as even about it. So, I have realtor partners with Rock Group. What we do is we represent our clients to buy and sell real estate. And we do this from the education standpoint, in order to make sure that they're informed when they're making their decision. We partnered with EXP, and what we're trying to do today is to educate you and most importantly, invite Mark to come and share his wealth of knowledge to enrich us. So by the end of this session, you are able to get as much as possible that will help you to be confident when you're making decisions to purchase real estate.
Outstanding. And make sure if you haven't done so already, follow Richard. I honestly look up to him with respects to his content and his delivery online. Certainly not as well dressed. I hope to one day, but certainly have a look at his handle there at the bottom. So my name again is Mac Phillips. I'm actually what's called a mortgage broker. I'm going to be there as your best friend moving forward to make sure that you get qualified and you have the ability to actually close and take on financing. So I've been a mortgage broker now. It's almost 6 years in the industry. My prior life, I was actually in hospitality, where I ran 4- and 5-star hotels around the GTA. I'm a platinum broker. It's just really a fancy term for the volume that I provide or volume that I do each year. Last year, I helped 72 families get into homes, and I'm hoping to do that, if not more, this year. Totally about 300 to 400 families that I've helped in my career. And I'm also a real estate investor. Why that's so important is because, as we both know, not only do you want to have someone who can talk the talk, but someone who's actually been in your shoes, understands the pain points, the concerns, sometimes the anxiety and the stress that goes around being a homeowner. And I've been on both sides, working with families through the business, but also walking through purchasing properties. Okay.
Hi, Mark. I think you've not shared your screen.
Oh, you don't see you
I
don't,
can see your screen. I don't know if everyone can see your screen. Your
okay.
screen just gave me a notch now.
Okay. Let me try that one more time.
Okay.
See if I can do that. Thanks for mentioning.
Oh.
Present. Let's try and share that. Does everybody see the screen now?
Yeah, I can see it.
Yeah, we can see. We could see it before. So, Richard, if you still can't see it, then you have to check your
I can
side.
see it. I can see, but someone gave me a nudge. But
What did they?
Newton, can you see it now?
It's all good now. It's all good.
Okay.
Yeah, families can see it? Okay, fantastic.
Okay, cool.
Awesome. Okay, beautiful. So yeah, I'm also a real estate investor. Why is that important? We just want to make sure that you have people who can speak from experience, their own experience. Right now, I live in a townhouse, but I also have some investment properties up in the Ottawa area as well. Okay. So what we're going to be doing is firstly talking about market conditions. The Bank of Canada announcements, there was actually one as of yesterday, and they decreased interest rates even further. So prime came from an eye-bulging 7.2%, and over the last 6 or 7 announcements, we're all the way down now to 5.2. That has a massive impact, not only on your ability to qualify, but also on the market. The lower the rates, the higher the values. So if at all is anyone thinking about buying in 2025, we are at a certainly ripe for the taking opportunity to get into the market now. I think it's always cool to understand just where the market is, what rates look like. Often we speak with families and it's one of the first questions they ask, and I love getting right to the meat and potatoes. So first thing is variable. The way that variable is priced is what's called prime, and then they provide a discount to prime. So each bank has a different rate when it comes to variable. What you could expect right now for an insured purchase, which means less than 20% down, would be prime minus 1%. So somewhere in the neighborhood of 4.2 to 4.3, depending which lender you're working with. And if you're looking at a fixed interest rate, and why it's so competitive now is because variable's always been higher. Often people default to the lowest interest rate, but now they're finally neck and neck. Fixed and variable are literally almost exactly the same priced. So that's when it comes down to strategy, advice. What's most important? Because the interest rate is honestly secondary if they are, in unison. So I believe it could be a great opportunity now for Richard to just talk about kind of what's happening with the market.
Okay, yeah. So in terms of from the real estate wing, I know a lot of people, the most common question people ask is it the right time to buy? And I know most of the times what you get from agents is every time is the right time to buy. But the essence is when you understand the market, when you know what is happening with interest rate, if you're very confident with what is happening, you know now is actually the right time to buy. And it's not because of the cliche, but it's because interest rate they're going downward and prices have dropped significantly over the years, right? Last year was all through sellers market. Buyers market, and we're still in the buyers market. So what makes buyers market? Buyers market is when we have a lot of listings in the market and they're hard to sell. That means you're able to take advantage of that. You're able to negotiate the conditions. You're able to get it at a very good price. And you are able to see a lot of options. When you are in the seller's market, what happens is sellers, they cut the shot, right? They get a lot of interest in their property. And because of that, they raise the stake. That increases the price. And also you're unable to or limited to put a lot of conditions in the property when you're buying. So to put it in the very simple terms, when you're working with a real estate agent like us, and we're in the seller's market, there's limit to conditions you can put in your offers because when the seller has 5, 6, 7, 8 offers to choose from, there's high chances that they will get some offers that have lesser conditions and higher prices. And that was what happened 2021, 2022, where people are bidding on top of very high prices with less conditions, and they're making huge investment decisions and moves without protecting themselves at the full length. So, but in this current market that we are in buyer's market. But what I can confidently tell you is, I don't think this is going to last for a long time because of the interest rate coming down. But it will be interesting to know what happens in spring and summer.
Yeah, well said.
Yeah.
Yeah. Why don't I take this one, or did you want to take this one, Richard?
Yeah, you can take it. Go, because you can take it on how it affects the mortgage.
Absolutely. Okay, that's actually a good point. So what we're looking to do right now is give you an understanding as to how do we determine what property type is best suited for you and how it impacts your qualification. So if you're thinking about condo versus freehold, some of the things that we educate families on is, what's your family dynamic like? Do you need to be in the core versus in a more rural area? Are you looking to have home maintenance? Are you looking for something that's the maintenance is done for you? But also with respect to the qualification, a freehold doesn't carry that additional condo fee. So if you're thinking about qualifying for a mortgage, you would get more buying power or more money would go towards your mortgage if it's a freehold than if it's a condo, simply because of the additional maintenance fees. Often when we decide which is right for you, sometimes it's simply budget related. If you're only pre-approved for a purchase price that allows you to get into a condo, then it's really decided through your current affordability. If you do have, the ability to qualify for a larger amount, depending on your location, that's when we want to look at more desirable properties. When we say desirable, we're talking about the resale ability. If you look in the downtown core right now, there is a plethora of condominiums on the market. So they're ripe for the taking for you. And if you're thinking about a freehold property, there's just a lot more demand there because of the obvious reasons. More space, you actually own a part of the ground versus a piece of the sky. And often the appreciation is more aggressive with a freehold than versus a condo. Anything you want to add to that, Richard?
Yeah, absolutely. And I just want to also touch on the fact that I know a lot of people, there's a lot of stigma with condos. Because it has maintenance fee doesn't mean it's a bad investment move, but you need to understand what works for you. And also, those maintenance fee actually covers something. Majority of the time, what people don't know is they feel like they pay the maintenance fee and, it's just a waste of money. But again, we are all in different phases of life. There are older people that want to live in a property where they don't have to worry about some part of utility bills, maybe like water. They want to have access to elevator. They want to have the amenities around them. And also they don't want to have to deal with stairs. Also, it reduces your monthly commitment into your home and also maintenance. So it covers something. But again, when you have big family, most of the time condos don't have enough space for big families. And that's why people find freehold more attractive. So it all depends on individual choice and where you're in your phase of life. So that's where you know what is right for you. But when you're working with your agent, it's always important to sit with your agent, establish what you want, what you need, and that will definitely channel you to the right, what is best for you, and take the conversation forward with the mortgage broker.
Beautiful. Okay, so what we're going to be covering today in the full and detailed buying process, it actually starts with me. Often, a bit of a switch with respects to traditionally the way that a home buying process was. You would find a fantastic realtor, you would look at 150 homes, fall in love with one, and then realize, holy smokes, now we need to get qualified. So it's exactly the opposite now. So it starts with a pre-approval. We want to make sure that you are investing your efforts as well as your real estate team are investing their efforts in a property that you can accomplish and purchase. We're going to be talking about the ins and outs of finding an agent, why that's so important. The person you interview and build a relationship with is massively important to your success. We're going to be talking about what it is to start looking at properties, how that process works. We're going to be talking about the full making an offer process, things to consider, ways to protect yourself, what happens during the conditional period, finally closing, and then the big moving day. Okay, let's jump right in. So getting pre-approved. So that's with me. So the first thing is you need to understand, why would you want to work with a mortgage broker? And that's not just me. There are thousands of mortgage brokers around Ontario. And what you want to do is decide what's the value there. Okay. So first thing is we want to protect your credit score. Sure, you could walk around to all 5 or 6 banks on your own, but you'd have to have your credit checked at each one. When you're looking to purchase a home, we need the highest credit score possible. We don't want to sacrifice your success and abilities to purchase a home simply because you want options. That's the reason for the mortgage broker. We have access to every lender in Ontario you've never heard of, and solutions that we can then engage on and provide an understanding as to where it's best to take your business. Okay. Second thing is that you want somebody that's removed from the bank. We don't work for the bank directly. We work for you as the borrower. And where it's competitive is that you're actually going to have a non-biased opinion, not only on the bank that you're going to work with, but also perhaps the ones that you should steer clear of. There's 5 or 6 major banks for a reason. They all do business a little bit differently. Some are going to be better suited for you, and some you would certainly not want to invest your time and efforts in. And then lastly is just around the strategy and the advice. The working with the bank directly is very self-driven. You have to know what to ask, what the goal is, and often the only information they leave you with at the branch is the interest rate. Sure, interest rate is massively important, but it's just one component to ensure your success. You want somebody that can hold you by the hand and give you some clear insight as to what's best for you, what's best for your family, and what's ultimately going to keep your hard-earned dollars in your wallet. So what does a pre-approval process look like? What do you need to be prepared for when looking to purchase a home? So the down payment is a big one. I find that often folks think that this is secondary to their success, and it's actually one of the biggest hurdles that you have to overcome. Not only the saving for the down payment, but how do we show the down payment? If the money is under your bed, we can't use it. It needs to get into the account. If you're a business owner and you want to use the funds that you're generating in your business, get it into your account. Okay, so what an insured purchase means, and quite plainly, is you're putting down less than 20%. You need to qualify for the CMHC insurance. There are other insurers, but I think that's the one that most people are conscious of. And if you're putting down less than 20%, you actually get the best interest rates. Often people think, Mac, what do you mean? I'm putting down more. I have 30% down. Do I get a better rate? No, you don't. And this is why. When you purchase a home with less than 20% down, the insurance is actually covered by CMHC in case you default. Let me give you a really easy example. If you bought a home with 5% down, your insurance premium is 4%. That means that gets blended into your mortgage. So from day one, you have 1% of equity in your home. Not a good feeling for many. So that's why the insurance is important. With conventional purchase, which just means 20% down or more, it means that the bank themselves are covering that insurance. In case that you were to default on your mortgage, the bank is left holding the bag, versus if you default with an insured purchase, it's 100% covered. Okay. With respects to income, very easy. Business for self is what the BFS acronym means. We can assist families that are corporate, sole proprietor, tax returns, no tax returns. Those are solutions that you wouldn't get working directly with the bank, that you do have options working with the mortgage broker. If you're full-time, maybe you're getting into a new role, maybe there's an opportunity to progress into a new role, perhaps you're going to be on probation for a few months, don't give up that opportunity. That's often misunderstood, that you have to be in a role for a year or have passed probation to be able to get a mortgage. That's simply not the case. As long as you're in a field where there's lateral trajectory or even an increase in your role, many and most lenders do not care if you're transitioning, as long as you're not going from plumbing into a chef or from a DJ into a painter. Now we're saying, okay, what in the heck's happening? Otherwise, you're good to go. Your credit. I've often spoke with families that have said, Mac, I've got a 900 score. Do I get a better rate? Or I have a 900 score. Do I get a higher pre-approval? With credit, it's simply a minimum barrier to entry. If you're purchasing with an insured purchase, you have to have 600 or above. Whether you're a 601 or an 852, it's the exact same solution you would get at the bank. Okay. And then lastly, with foreign buyer policies, the government put a foreign buyers ban in place during the pandemic because they thought that there was too much outside of country money coming in, gobbling up the existing real estate. Honestly, it was only really 1 or 2% of foreigners who were actually buying real estate. So I don't know if that was actually to help us or more of a political scheme, but either way, right now you have to have PR to purchase a home in Canada unless you have deep pockets. They have something called the non-resident sales tax, which is icky. I don't like to say it, but it's 25% of the purchase price you have to pay until you get PR, and then it's rebated. So for many, it really wasn't an incentive. It was more of a way just to stop anyone without status from purchasing a home. So not a big fan of that program myself. The types of lenders. So I'm going to run through this quickly for you. You have the big banks, the A lenders that everyone is aware of, but there's actually some A lenders that you may not have. And what they're called is monoline lenders. And just what the name invokes, with mono, they do one thing. Just mortgages. No checking accounts, no savings accounts, no line of credits in many scenarios, but they offer better rates, better products, and better customer service. If you pick up the phone, they actually answer. Okay. And then the one just to the right with the credit is actually credit unions. So if you think of the hierarchy of who has your mortgage, it's the big banks, the credit unions, and then you go down to what's called a B lender, which is essentially a non-bank lender, but they're very strict. but they do actually use a more of a common sense approach, where if you have good credit, and we can actually use business income to qualify versus just your notice of assessments. Okay. The fixed and the variable we actually talked about just a moment ago, so I'm not going to dive into that too deeply, but just as a high level understanding, fixed payment will not change till the next term. You always have the ability to renew based on the length of term that you've taken on, or a variable if you're okay with a bit of a roller coaster. There's two variables, one where the payment changes and one where the payment doesn't change. And there's obviously pros and cons to both. Lastly, rate hold. Why is this important? Rate hold is important because your rate is actually tied to what's called the stress test. Higher the rate, higher the stress test, lower the budget. So if I've pre-approved it today and I've given you a 4% rate and then rates go to 4.5 or 5, well, guess what? Your stress test has gone up, which means your buying power has been reduced. So if you think that rates are on the move, you want to give yourself some confidence of being able to buy a home in the future, get a rate hold, get it locked in, you can't lose. Beautiful. So let's find out when is time to have she find an agent.
Okay, so again, just like as Mark touched on, once you get pre-approved, then the next thing for you is to find an agent. Why getting pre-approved first is very important is because it gives clarity for both parties, right? The last thing you want is you getting on the market looking for homes only for you to find out later that you don't even qualify for the price range that you're looking for. It's a waste of time, and not only wasting anybody's time, but also because it just discourages you, right? When you start looking at some certain home and you already have your heart tied to it, when you find out the reality of what you actually qualify for, that can actually discourage you to get out of the market. So it's always important to know what you qualify for, and that will give clarity for all parties to be able to achieve the best result. So now, how to choose the right agent. So we are in the referral business. What I do advise is get referral from people that you can actually trust whatever they tell you. We've seen people that just refer people just because, oh, I know this person. That is really good. But take referral from people that have used these agents and they have good things to say about them, right? Obviously, at Rock Group, we would love to represent you. And this is why we've gotten a lot of reviews, positive reviews on Google of what we've done and how we've been able to service our clients. And one of the way we service the clients is what we're doing today by educating them. So you want to gear towards more agents that will educate you, not just every time is the right time to buy, right? The power of you being educated is because now you have a power for you to object things, right? Because now you have the knowledge to a certain extent, so you know what you want and you're able to ask the right questions, right? So that's how to choose the right agent. Take recommendation, but do your own due diligence by actually checking on their reviews and also do more research about them. Now, how much does it cost for you to hire an agent? Well, in this part of the country, it's completely free. Okay, there's no cost to you to hire an agent to buy real estate. To sell, yes, you have to pay the commission of both parties of the buying agent and the selling agent. But when you're buying, there's no cost to you. Now, have we seen cases where clients have to pay when when they're buying a property? Yes. So when you hire an agent, the standard way is for you to sign a BRA, buyer representation agreement, which means you're exclusively working with an agent. For whatsoever reason, once you signed out with an agent and you go behind to work with another agent and put offer on any of the properties that they've shown you, you will be liable to pay the commission that is required on that document that you sign. So provided you stick to an agent that you sign BRA with, and the transaction is between you, you are not responsible for the payment. And this covers whether you're buying resale or you're buying pre-construction. When you're buying resale, the seller, they are responsible to pay that buyer's agent commission. And when you're buying the pre-construction, the builders, they're responsible to pay the commission. So what you just need to do for yourself is making sure you get the right agent that will have your best interest at heart. Now, question to ask your agent. When you meet an agent, the question to ask an agent, obviously, you want to understand the market that you are in, whether you're in the seller's market or you're in the buyer's market, for you to be able to make the right decision. Why that is important is it creates expectation. You know, if you have to move first, or you need to take advantage of the time, right? Second thing is you want to ask, you want to, for an agent to give you the right advice, you also need to be able to open up to lay down everything that you need and for you to be able to set a clear and realistic expectation. Another question to ask them is how long have they been in the industry? Why that is important is, again, there's nothing wrong doing things the first time, but you want to work with an experienced agent that will be able to guide you. They probably have made their mistakes, learn more about things, and you don't want to be the first person that they will use to text, what you want to do. So that experience is very important because they found themselves in that scenario maybe multiple times, and that will also help their own judgment and decision. Now, when you're working with a new agent, and that's why we work as a team, because we leverage on individual, superpowers and our experience for us to be able to get the best result for you. And that's why I tell people you're getting 6, 7 specialists for the price of one, right? Because we work as a team. So you want to know how long they've been in the industry, you want to understand the market that you're in, and also you want to lay down everything you want for them to give you the right advice.
Well said, Richard. So now let's talk about viewing homes.
Okay. How long does it take to find a home? Again, it's tied to the market that you're in. When you're in the buyer's market, it can take you faster to get the house you want because you get more inventory that will stay longer in the market. That way you have more options in the market and they stay longer and you're able to get the house. On the average, to find a home, it all depends on the market and also depends on how realistic you are with your budget. And this is why getting pre-approved is very important. For example, if you're working in an area, for example, you're working in Toronto where average detached home is selling for 900. If you have a 700 budget, that might actually take you longer in the market. So if you're being realistic with the type of home you want, that you want to buy with the budget that you have, in a buyer's market, on the average, a month to 2 months, you should be able to get what you want because you have more inventory in the market. Now, in a seller's market, can actually take longer unless you get panic and you don't do your due diligence. Because what happens in seller's market is you get a lot of bidding wars and you're probably getting bidding out if you don't want to overpay for homes. And this is why we advise people to come more into the market in the buyer's market. So I would say on the average, 1 month to 2 months, if you're being realistic with the budget and what is obtainable in the market. Does it cost anything to view homes? No, it doesn't cost anything to view homes. We're actually paid well, and it's our duty and our job to show you as much homes as possible. Yes, you might get a few objections from agents if they feel like the type of homes you want to see, it's not within your budget, and that is, to respect you and also to save your time. So it doesn't cost anything. If you're working with an agent exclusively and you're not working with a lot of agents, I would be surprised if any agent charges you any money for you to view them. So it's completely free. Now make an offer. So you found your dream home. Now what next? So once you find the home, you view the home and you like it, the next thing is for you to sit down with your agent and put together an offer. What makes an offer is the agreement of purchase and sale. This is the standard form that presents your interest to purchase the home. And there are a lot of clauses in the form a lot of clauses that protect you, but the major ones are the purchase price, the deposits that you will be putting down on the property, and when you want to close the home. Those 3 things are very key. And those are major indicators for the sellers as well. They want to know how much you're presenting. Now, in terms of the purchase price, the first price that you put on the offer might not be acceptable. It's okay. Most of the time we go back and forth. So if they list a property for $700,000, for example, you can put in $650,000. If the sellers, if they are not satisfied with that, if they want more, they can sign back to you at 680. You sign back at 670. So you can go back and forth until you find a middle ground that works for both parties. The next is the deposit. The average deposit is 5% of the price that you're offering. So if you're offering $700,000, on average, you want to offer $35,000. But do we see cases where you can offer way less than that? Yes. especially if there is no bidding war. Sometimes what we do is when there's bidding war and there are multiple offers, we go stronger on the deposit so we can get some leverage on the price. And that deposit is refundable if you do not firm up the deal. If the deal falls through before you firm up, yes, the deposit is refundable. And the third one is the closing date. Both parties. I got a question from a client yesterday, and she asked me, "Oh, who determines the closing date?" I told her, I said, it's a mutual, it has to be a mutual agreement between the seller, what works for the seller and the buyer. But because we are putting the offer, we are going to propose the closing date first. And if that works with the seller, they sign off on it. If it doesn't work with them, they sign back on the closing date. So we put all of these offers together. And another component of the offer are the clauses and conditions that protect you. We put financing condition, which means within that financing period, Mark needs to get you the mortgage approval. And once you get the mortgage approval, you're clear to waive that condition because that is what protects your deposit. We put an inspection condition, so we get an inspector in within 5 days or whatever day that's mutually agreed for them to inspect the property and be sure that everything in the property is up to standard and you're not just going blindly to purchase your home. And another component of the clause that we put in is also stigmatization of the home. They need to give full disclosure of what has happened in that home. Maybe someone has died in the home or anything that can actually affect you selling the property down the road. So there are a lot of conditions that we put in the offers just to protect you and making sure you're making a sound investment decision. So yeah, so that's how an offer is put together. Your realtor will help you determine the purchase. Yes. So, and when we're putting in the purchase, when we're putting in the prices don't just come from what you think or what I think. We base the prices based on CMA. We do market comparables to check what are sold in the area that matches the type of home that you're interested in. And also, most importantly, what is happening in the market. If we're in the market where prices are dropping, because they are sold for 700,000 doesn't mean we have to offer 700,000. We can leverage on the market trend as well to offer less, which is what we've experienced in the last 2 years, and we've actually taken advantage of that, and we're still doing that to date. But when we switch to a market that is a seller's market, that might not be applicable, right? Where prices go up every month, right? So we need to understand what the market is saying and also check comparables in the area of a comparable home. Now, comparable homes that are like, right? That you can compare, not a townhouse to a detached. So that's how we base the price to make sure that when the bank now takes the offer and they do their own appraisal, they don't find that property lesser than what you purchased it from. Now, types of offers, firm and conditional. So I touched on firm. Firm is when we put an offer and we waive all the conditions. And in a seller's market, that happens a lot because they have multiple offers. They don't want you to put any conditions at all. What that means, they don't want you to protect yourself in any way. Because during the conditional period, you can actually pull out of the deal saying, oh, I was unable to get my financing. I'm backing out. I'm getting my deposit back. Or you did an inspection and you're not satisfied with everything you found in the house, you can back out. There are a lot of clauses that can get you out of the deal. And it only makes sense for a seller not to want to go with that offer if they have other offers that it's a firm deal. Because firm means price is agreed, closing date is agreed, deposit is agreed, no condition is holding you back. You put down the deposit and that is firm. You can't back out of the deal until closing, and you're clear to close. So those are the two types of offer. Is that you do a firm offer or a conditional offer?
Okay. Why don't I jump in, Richard, and do these conditions? So
Yeah, I think
I deal with these all the time. I think the inspection one is primarily what you would see working with your real estate team. And what they do here essentially just want to protect you. I just wanted to go back to 2020 and the example that Richard provided. The market was so hot and heavy, people were buying properties sight unseen, buying it from the virtual tour, have never even been to the property, and waiving inspections. So what I noticed was there was a lot of problem properties being offloaded during the pandemic because people were not noticing, hey, foundation issues, et cetera, were not being determined. So always protect yourself, even if the home looks brand new, even if it's a condo and it's a brand new building, always get an inspection. You just want to make sure that anything can be determined prior to you going, what Richard mentioned, firm. Why is that important? You can negotiate the price. you can have additional inclusions, or you can back out if you're not comfortable with something that you find. Okay. The financing condition traditionally is 5 days, but we have actually been using the financing condition as a competitive advantage. Can we get it done in 3? Can we get it done in 2? Can we get it done in 1? Or do we do our full due diligence up front and actually not require that condition at all? And that will be something that we would want to negotiate based on the competitive nature that we're in around that property. If there's no offers, we really have the ability to set the terms. But if you're fighting against multiple offers or even a seller that is very stringent on the need for what's called a firm offer, then we can work around the ability to have financing waived. That's why we do a pre-approval, so that there's no surprises on closing day. And then lastly, the status certificate has everything to do with properties that would be what's called a condominium. What are we looking for? We're looking for reserve funds. We're looking for lawsuits. You'd be surprised. Maybe there's a slip and fall in the lobby of the property that you're buying, and now the condo is actually not being managed well. Why is that important? Because the lender needs to be able to extend funds to you and know that the property is also being maintained. If the property isn't being managed well, perhaps it won't appreciate, or worst yet, perhaps it won't turn over. Lenders always look at it from worst case scenario. If I had to take your house from you, can I sell it? Is there a demand in the marketplace for your property? And if the condo certificate, the SAD certificate, the condo is being run into the ground, chances are it's going to be much, much harder and longer to try to sell the property. Okay. Anything you want to add to that, Richard, before we move on?
Absolutely. Not really. I just want to touch on the importance of our starter certificate. It's something that a lot of
Yeah.
agents actually overlook. But honestly, it's not within our control to know what is going on at the back end. A lot of this corporation, they're facing against lawsuits, and what happens is down the road it becomes a stigma, or it becomes something that makes it hard to move such products, right? So that's why it's very important for you to get a lawyer to review that. And on the average, that we put more days for that conditions more than inspection and financing,
Yes.
because it takes about 3 to 5 days for them to get it when they request for it, and it takes a couple of days for the lawyers to actually review it.
Mm-hmm. Yeah, it could be 20, 30, 40 pages long.
Yeah.
Sorry, Mark. Mark or Richard, can you touch on the importance of reserve fund? I know Richard just touched on the litigation part, but if you can touch on the importance of reserve funds, I think it will also help our clients. Thank you.
Sure.
I can take that.
Go for it.
So reserve funds is basically so when you buy a property that has maintenance fee, what happens is they set some portion of the money aside, they put into reserve funds. What that does is that is what they tap into for them to maintain the building, or when they have any use that they have to incur. Now, why that is actually very important is when you live in a condominium and you pay for maintenance every month, you want to make sure that the condo board can actually fund any major expense that needs to be made, right? You don't want them to start splitting that on all homeowners. So when they have enough reserve funds, that gives confidence that if anything ever happens, or maybe they even get, they get sued, right? Or they have to do major expense, maybe like replacing the pool or anything, there's enough funds, right? So that's why they review the starter certificate to make sure that, okay, they actually have enough funds to take care of all of these things. When you review certificate and see that they don't have enough funds, what means is maybe they're going to lawsuit, or they've been spending on major expense, and probably you need to look further on why they don't have enough reserve funds. So that's actually something very important. And again, it's not really on you to review. It's always good to give it to a lawyer to review.
Just want to add one comment in addition to that, but that was a really good explanation, Richard, is if there's very low reserve funds, you have to think from a business perspective, how do we bridge that gap? It's going to be bridged on your back. Don't be surprised then if all of a sudden your condo fees go through the roof over the next couple of years, because we need to reestablish those reserve funds. So be very careful. If the condo isn't doing well, make sure you've got pockets for some extra condo fees.
Absolutely.
Yeah. Okay, so making an offer, what is the deposit versus the down payment? So many folks ask me what this looks like, and whenever we do a pre-approval, we prepare you for offer day, because often folks have their money tied up in investments. Maybe it's in an RRSP. The funds need to be liquid and accessible for you to put a 5% deposit within 24 hours of your offer being accepted. That deposit goes towards your down payment. So depending on the purchase price, your deposit and the down payment could actually be the same figure because you could be just buying with 5% down on a $500,000 condo. The deposit and the down payment would have already been provided from day one. Okay. Richard already eloquently provided that your minimum deposit, and remember, there's nothing carved in stone. It's just kind of what's typical today is 5%. But if you want to be really hungry and aggressive, the larger the deposit, the more interest the sellers know that, hey, you know what? He means business or she means business. Let's look at this offer more aggressively. And then when the deposit is made, often it's made within 24 hours. However, I have seen some unique scenarios where, depending on the access to capital, you could see like a tiered approach where, hey, we're going to do 30,000 within one business day, and maybe another 30 or 40,000 in a business day or two following, because maybe there's a limitation on the funds that we can get, or it's just sweeter to be able to provide that tiered approach. But that minimum 5% should be available in an account that you can access and provide either a check or a wire within one business day. Okay. Okay, so was that perfected? I guess I can touch on this as well. So once your offer is accepted, this is where I get reignited into the process. More than likely, I've already been engaged on offer evening, so I've been given some good news, but that's when the documentation that we have actually gets put into play. What we do is we'll have a one-on-one or a one-on family strategy session where we say, okay, you're pre-approved, but now let's dive into what lender, what term, what rate, what length of term, and make sure that we're fine-tuning that solution. And then we submit that application into a lender for approval. And when we do that, we're in what's called the conditional period if that's been negotiated. Often it's between 1 and 5 business days. And during that time, I hound the lender. Often the squeakiest wheel gets the noise, or the oil rather. And in that scenario, we actually get approvals quite quickly. We do a lot of volume with certain lenders, and that's the relationship that we have to be able to best support you, where we can get the approval quickly, get the documents out to you so that you can actually put eyes on them and sign them while we're still within that condition period. Nothing breeds more, risk or uncertainty into an application or into a family where they're waiving conditions and they haven't seen that documentation or that approval yet. Okay, and then we move forward towards closing dates. Often there can be multiple closing dates. Perhaps you're selling and you're buying. Do they line up? Is there a bridge involved or required, or is it simply a new purchase? And the closing date is the day that you either get the keys or the date that the funds are actually provided to your lawyer for them to register and close your mortgage. So a big day. Often I recommend that if you're selling and you're buying, take a bridge. Don't do it all in one day. Why is that? What if the person buying your home doesn't close? Now the home that you're looking to move into, that won't close either because the funds need to be moved forward. So if you're taking a bridge, it allows for those kinds of last minute changes to take place. But even more importantly, I think from just a consumer perspective, you can get into a home while it's empty. Your truck is not parked outside getting cold in the winter. You can actually get in, you can clean, and you can move over far more seamlessly. So if you're going to be buying and selling a new home, I often recommend at least a 7-day bridge. It's a couple $100, but it's worth it, and it'll definitely give you some peace of mind that when you're looking to close, that you're prepared for the eventualities that there can be issues arising that are out of anyone's control. Okay. Okay, so these are some of the closing costs you want to consider. So land transfer tax. If you're in Toronto, there's a double land transfer tax, municipal and provincial. Otherwise, just the one. And you also get a rebate that I'll talk about in just a moment. Land transfer tax outside of the down payment is the largest closing cost. Okay. Whenever you're thinking of closing costs, just have allotted mentally 1.5% of the purchase price, and you'll never go wrong. Lawyer fees are $1,500 to $2,500 depending on the complexity of the transaction, disbursements, the lawyer that you choose. Don't just find the cheapest one, but even more importantly, use us and use the Roar Group team. There's a reason why we have a vetted team around us. Painters, carpenters, plumbers, lawyers, inspectors. That's important. You don't want to pick up Google and find the cheapest lawyer. Often cheap in, cheap out. The appraisal fee is between $300 and $500. If you're buying with less than 20% down, often the insurer will pay for the appraisal for you. But if you have 20% down or more, that's an additional cost. So when we actually are within that conditional period, I do two things. I get your approval for your mortgage, and I also order an appraisal. That is paid for by the client, but in many scenarios, we just rebate you at closing. Saves you about $500. And then lastly, the inspection fee. I don't personally deal with the inspection ordering. That's something that your realtor would do. But from my understanding, it's about $500 or less, depending on the property. And that's also a condition. That's also a conditionary period. Often 2 to 3 days, you get the inspection done. And it just gives you that peace of mind that you're moving into a home that has no skeletons, if you will, in the closet or behind the walls. And this is probably something that would be better for you to broach, Richard, and then we'll touch on some first-time home buyer benefits.
Okay, great. So pre-delivery inspection. So this can come in two tiers. It can come if when you're it happens when you're buying a resale, and a resale means a property that you're buying from a seller, right? An existing property. While pre-construction is a brand new home that you bought from the builder. So pre-delivery inspection comes after the offer is accepted and you've purchased the home officially. From that time to closing, you have the opportunity to visit the property twice. The standard is 2 times, but sometimes people want to visit 3 times, but it's something that we need to put into the offer and they need to sign off it. And what happens is you have 30 minutes to an hour to go into the property, take measurements, check everything again for you to be confident with your decision and know whether you make the best decision or not. But it gives you the opportunity to go back into the property, take friends and family, take contractors, which is very important. Sometimes people want to take contractors in, to check things they need to do, or painters, and you can have up to 2 to 3, or you can do that 2 to 3 times. But for us, what we always advise our clients is you can take the first 2, but you need to give us one of those showing because we want to keep it to the almost very end of the closing. The importance of that is after you purchase the home, on the average, the sellers still have about 1 month to 3 months to live in the property. A lot can actually happen in that phase. So that's why we keep the last day. We keep the last day for us to the last inspection close to the closing date to make sure everything still works. Now, if you want to take this to another level, we can actually take an inspector in a day or 2 days too, most especially if few things are spotted during the inspection, right? During the inspection, we want to make sure that we go in with the inspector and make sure that those things has been fixed by the seller. Because what happens is when the house closes, it's a whistle. It's always very hard to track anybody back into the deal. It has closed, money's has exchanged hands, and you've gotten the key. It's your property from there going forward. So that's the importance of that. But when you're buying pre-construction, it's a bit, it's a bit more, it's lesser of a worry for us and also our client, because now you're buying a brand new home that has 7 years Terion warranty. What that means is there's a pre-delivery inspection, which we call PDI, few days or a week before the builder deliver the property. And what happens is they go through everything that you need to know about the property, and they will identify further things that need to be fixed. But you're not to worry. It's not like a resale. They do not have to fix everything before closing date. Because it's a new build, they can still come in and send in their trades to make sure everything is fixed. And it doesn't hence there. You have it from 1 year to 7 years. The first 2 years for everything in the house, and up to 7 years to cover structural defects. And you have something to say?
Yeah, I just wanted to mention that for resales, most especially, you can't go into the property during the pre-delivery inspection. You can't go into the property without your realtor. So just for any reason, if there's anything that you need to do, if you need to go in with your handyman, an appraiser, or a home inspector, it must be with a realtor. Thanks.
Okay. Yeah, you're right. That's actually a very good point. Because you've now bought the house, you're waiting for closing. It doesn't mean you can just show up at the property. No, we still have, even us as your realtor, we can just go to the home. We still have to book showings with the seller's brokerage, and the seller they have to approve the showing for us to be able to go in. So, and prior to planning, So it's just very important you don't want to purchase the house and wait until closing and feel like you don't have to do anything. It's important for you to become your realtor and make sure you still make visits to the property and still check everything to make sure everything is fine and good before the closing date.
Beautiful. Okay, so this is some of the dessert, if you will, to the presentation today, is focused around some of the benefits that the first-time home buyers get. So we're going to talk about that, and then as well as some really cool down payment support programs. So first thing is the first-time home buyer savings account. If you do not have one, rush out and do it now. The first-time home buyer savings account is actually even more robust than the home buyers plan associated with the RRSP. Why is that? The FHSA is not a loan. You actually are able to invest in that vehicle, and when you pull the funds out, they're tax-free and you don't have to repay them. You get $8,000 per annual year. The reason why you want to rush out and set it up right away is because even if you don't contribute, there's carry forward room of that entire $8,000. So if you think that you may not use it for a number of years, perhaps you're in your you're in your initial earning years, and you're not going to buy a house for quite some time, open it anyways. When you're finally at a position to begin contributing, you'll be shocked at how much ability you have to put funds in. I was actually having a conversation with a financial planner just the other day around when do you contribute to the FHSA? And you actually want to contribute to the FHSA in your highest earning years. And that was actually new information to me. I hadn't actually considered that. Why is it important to contribute during your highest earning years? Because it's a tax rebated program. Whatever your marginal tax rate is comes back to you as a cashback. So when you're earning $30,000 to $40,000, your marginal tax rate is far below than what it would be if you're earning 100,000 or more. So perhaps if you know you're not going to buy for a number of years, contribute later in life. The home buyer's plan operates the exact same way. However, it's actually a loan. You put the money in, you can contribute as much as $60,000 that can be pulled out tax-free. You get the tax rebates and incentives. However, when you do pull the money out, you actually have to put it back over the next 15 years. The first year is your first grace period year, and then after that, you actually have to contribute on an annual basis until the money is fully back at the end of 15 years. Many families that I'm working with ask, Mac, how in the heck am I going to put 60K back in the account? If you've been in the same home for 10 or 12 years, you can easily refinance, put a line of credit, an additional trade line on the home, pull the 60K out, and recontribute back to the RRSP. You have the ability to not return those funds. However, if you do, you'll be taxed on those proceeds. Okay. The land transfer tax rebate, I actually wish that they would not call it that. Honestly, it's not a rebate. It's just a reduction to your closing costs. So if you think of the land transfer tax on average in Ontario is right around $6,000 to $8,000 depending on the purchase price. And when I say Ontario, that means everywhere except Toronto. They reduce $4,400 from your land transfer tax in Ontario as one bucket, and then in Toronto it's $8,800. I just wanted to clarify one thing that I get asked very often is, hey, I live in a home. It's under the name of my spouse. I'm not on the mortgage. I want to buy the next home under my name so I could use the first-time home buyer benefits. Sorry to be the bearer of bad news. If you occupy a matrimonial home with your partner, even if you're not on the title, you lose your first-time home buyer benefits because it's considered to be your principal residence. Okay? Not very popular, but accurate. Number 4 is actually a $10,000 income credit. Very similar to what you would expect with the RRSP or the home buyers plan, where they reduce your taxable exposure by $10,000 when you do your taxes the year after a home purchase. Okay. Whereas the credit is that actually provides you with a $1,500 cash rebate on your taxes from Trudeau that does not have to be repaid. Okay, so whenever you do your taxes the year after a purchase, it says, did you buy a house last year? You tick yes, money arrives just like that. And then the last thing is the down payment support, which we will talk about in detail on the next slide. So what you're looking at right now is actually a first-time home buyer RRSP contribution boost program that I've been running successfully since at least 2023. This is the third year that we've run it. And the way that it works is that every year you have unutilized contribution room in your RRSP. How do you determine that? Grab your notice of assessment. Down on page 3, you're going to see it's where it says RRSP contribution limit. It's pretty easy. So it'll tell you exactly how much money or space you have in the RRSP. I did a survey of my database, and most people buying their home are between $15,000 and $30,000 short of being able to buy their very first home, their savings goal. Often we have that amount of space in the RRSP. So this is where it gets exciting. What you want to do firstly is get a pre-approval. You don't know how much you're short unless you know how much you need. Okay. Step two is we need to get access to that capital, whether it's through your line of credit, whether it's through a gift from mom and dad if the benefit is there, or you get what's called an RSP loan. There are lenders that offer programs purpose-built for the contribution to your RRSP. You take a loan, you put the money into your RRSP. Okay? Step three is deposit those funds. You need those funds to mature in the account for at least 90 days. So that can be done right now. If you're listening and you're $35,000 or less short from your savings goal, 2025 could be your year. You've got 30 days left to speak with us, get pre-approved, and understand what that capacity can be to then top up the account. In 90 days, when those funds mature, you can pull them out to go towards your down payment. Some really cool things. Let me give you some food for thought and some perspective. Let's say you're $15,000 short, okay? Your marginal tax rate is say 30% on average. You make about $70,000 to $80,000. I'm not good with mental math, so let's see. 15,000 times 0.3. So you're going to get back $4,500 when you do your taxes. That $4,500 can get reintroduced to your RRSP. It can go towards your down payment, or you can put it towards your RSP loan. Now we only owe $10,500. When you actually purchase the home, which is step 4, we actually have cashback mortgages. 1, 2, 3% cashback. Let's just say you bought a home, you needed 2% cash back. It's a $500,000 mortgage. You would get $10,000 as a benefit of working with that lender, cash back on closing. Now that RSP loan is paid off. You found $15,000 and you magically got it into your down payment, and now that loan is paid back to zero in 90 days. Okay? We can do that for you and your family today. So if you look at the examples at the bottom, just on the cash back you would get and the tax rebates, we can create on average between $20,000 and $35,000 from thin air. Okay, I know you're excited. The last one is actually what's called the Ourborough program. I encourage anyone to visit. This is my custom website, boostmydownpayment.ca. The way that Ourborough works is that perhaps you have 5%. We've pre-approved you, but it doesn't allow you the ability to get into the home of your dreams because perhaps your family dynamics don't allow for the home price that you were qualified for. What we can do is actually take up as much as 15% and add it to your down payment. Now you can qualify with a 20% down payment. What does that do? That allows you to firstly overcome credit issues. As we know, when you have 5% down, your credit has to be good. You have to qualify for the insurance. When you have 20% down, you no longer have to jump that hurdle. So immediately lower credit scores are available. Even perhaps or non-traditional income qualifications. Maybe you're a business owner, maybe you're a realtor, and your notice of assessment is low. We can actually qualify you with 20% down in different strategies. We can use your T4A, we can use gross income, and we no longer have to look at only your net earnings, what the banks want you to use. So if you're thinking that you need a boost to your down payment, you need additional funds, the Ourborough program can absolutely help you do that. So if you visit this website, it's a registration page. It's going to allow you to get some information, but also sign up. When we get your sign up, we'll call you, we'll set up a meeting, we'll engage you on this topic and see if this program is well suited for you and your family. So I'm excited because now we can answer some questions. And there was quite a few that came into the chat while we were going through this conversation today.
Absolutely. Thank you so much for that, Mac.
Yeah, thank you.
Yeah, I actually learned a few things today myself. Yeah, I didn't know about the website you just mentioned, but I think that's actually very good. And so I will invite you guys, to check out the website, and you never know, that can be the extra leg that you actually need, you need to push you forward on your home ownership journey. Now, to the questions, we have quite a number here, like you said. I think the first one came at 525, 625.
Yep.
There is a minimum family. Okay, is there a minimum family income that's considered when trying to buy a home?
So I guess that's a mortgage one. So folks, when you're thinking about qualifying for a home, there's no such thing as not getting pre-approved. Every family can get pre-approved. It's just, will that provide you with the shopping budget necessary to get you to the home that you need in order to maintain your family? So the way that I answer this question is, think of your family income, your total family income, childcare tax benefit, all of your jobs combined, times that by 4.5. Easy. Once you've times your family income by 4.5, that is close to the mortgage amount that you would qualify for. Add your down payment on top, and voila, you have a really good estimation as to what your buying power would be. Hope that helps to answer your question. Was it YA or yeah?
Yeah. Okay, great. Now, the next question is from Chioma. What is the least amount to get a house that has a basement? Okay, I think that's a real estate question. Well, there's no least amount, but there are a few things to put into consideration. The type of home you're looking at, whether it's a townhouse or a semi-detached or a detached, and most importantly, the location and how old is the property, right? And that is where you sit down with your realtor and you let your realtor know what location you're looking at, how big is your family, how big is the home you're looking at, and definitely will be able to advise you on what the price range should be.
Beautiful. Do you think it's a good idea to use my line of credit to make up for the down payment, or is it recommended to use my savings? So that's a really good question. What that comes down to is your personal capacity. So when we do your pre-approval, I don't just tell you, hey, this is your mortgage payment, see you later. What I do is I build out every family actually gets a custom proposal budget sheet for me. And we want to make sure that every variability around home ownership is budgeted for. Heating costs, home insurance, hot water tank, anything that's associated with carrying your home, I want to budget for you from day one. The last thing I want to do is have you get into the home, and when we have the 1 week call, be like, wow, my budget is actually a lot tighter than I thought because we didn't include all of the things that we know are necessary. The same thing goes to your line of credit. That's going to create an additional debt payment. Can that debt payment fit in the application? Or more importantly, can you manage your housing costs as well as pay down debt? You have the option to use your line of credit, but it would only be recommended if the family has the capacity to maintain the additional payments. Often we speak with investors who use like a line of credit towards the down payment. That means that the property is 100% financed. Line of credit for the down payment and mortgage for the mortgage. We don't want to overextend you or put in a position where cash flow or your ability to maintain the home is in jeopardy. Okay, hope that answers your question.
Okay. Oh, thank you, Mark. Also, please, I want to implore you, once we answer the question, please give us the thumb up emoji for us to be sure that, your question is answered and we
That's
can
a good idea.
one. Okay. So, next is Chichi. Can you back out of a pre-construction during the moving or occupancy period? What this means is you've actually passed the cooling period. Cooling period is when you show interest in a pre-construction, you put down the deposit and you sign all the papers. You have 10 days to give the agreement to your lawyer. After the 10 days, if you don't back out of the deal is now firm and you've actually purchased the property. So I know your question is for after the cooling period. After the cooling period, can you back out? No, you can back out because you now have an agreement that's in force. But if you want to make any of those decisions, I'll also speak to your lawyer to review that agreement again. And your lawyer will be able to advise if there's any loophole for you to back out or if there's anything that you need to do. But from the real estate standpoint, after the cooling period, you're firm and burned into the deal. But again, speak to your lawyer.
Perfect. Mercy, thank you for not forgetting about us and joining. Even a little bit late, that's perfect. So, can a student buy? You can absolutely buy as a student. What is an indeterminate or determinant to your ability to purchase is your status in the country. If you're a student, but you're a Canadian citizen or have PR, you absolutely can if you have the income to qualify. Often students are not working full time because they're focusing on education. If you have additional resources, access to capital, perhaps investments or a gift from mom and dad, let's have that discussion to see if you can still qualify to purchase a home while you're in school. A student loan is college, perfect. I think
the next one is for you, our Zoom user.
Zoom
Uh,
user. If I buy my first home, sell my first home, and now want to buy another, can I have access to my RRSP for the next purchase? That's a really good question. So the way that it works is that when you purchase a home, you get the ability to use your RRSP tax-free as long as you're a first-time home buyer. Don't confuse purchasing a home with being a first-time home buyer. And the reason I say that is because if you purchase a dedicated rental property, have never lived in it as your primary residence, you're still a first-time home buyer. Just because you own a home does not mean that you've forgone your ability. It's everything to do with where you live and the status of the home that you live in. I deal with this all of the time where folks bought properties in Windsor, in Chatham, in submarkets because they had the ability to invest there. They are still first-time home buyers. If you buy a home that you move into, it's immediately gone. Okay, Zoom user? Please get a copy. Of course, we'll make sure that everyone that joined the call as well as registered for the event today gets a full copy. As a first-time home buyer, how many percent are you supposed to have for the down payment? There's honestly no golden rule. It has everything to do with your ability to qualify. There is a minimum down payment of 5% of the first $500,000 and then 10% of the difference all the way up to 1.5. But there's nothing that's required outside of that. If you have more funds and you want to lower the mortgage payment, then you absolutely have the ability to put those funds in, Choma. If I have bad credit, can I buy a property? So we would have to look not only, Justice, what caused the bad credit, but also what we're doing to overcome it. So if you have a recent consumer proposal, for example, you have to have 2 years of a paid off proposal and rebuilt credit to get mortgage insurance. Okay. If you have 20% down, Justice, and it doesn't matter how poor or how good your credit is, you always have options to explore within the bank or outside of the bank. So let's have a conversation on exactly what the situation looks like and determine what lender and situation is going to be best suited for you. If I get a lower interest with less than 20% down, no, you should not, Sophie. The reason being is because when you put down 19.99% of a down payment, you're going to pay 2.8% of the mortgage amount as a mortgage insurance. That's going to far overshadow any savings by the interest. When I say a better interest rate, I mean like a quarter point, 0.3%. It's not enough to be able to overshadow the thousands of dollars that you would have to pay to get the mortgage insurance. Mercy, thank you for the thumbs up. That's a good question, Sophie. I'm not sure. I actually don't look at those very often. Maybe someone else on the Roar group could give you some understanding as to what they've seen with
Well,
reserve funds. Yeah.
for the reserve funds?
Yeah.
I think the reserve funds, it depends on how old the property or the building is, and also how old, and also what is also very important is the insurance coverage that they have. I think it's just also common sense. You don't for for a building that has up to like 150, 100 units, you don't expect them to have 10,000 to 20,000 reserve funds, right?
Exactly.
Yeah, there's no particular amount, but I've seen 500,000, I've seen 700,000, I've seen 300,000. I think in that hundreds of thousands, I think that will be more, I'll be more comfortable in that region than a, a building that has 100 units having just 5, 10,000 or 15,000 as a reserve funds.
Okay,
Yeah, well said.
so also touch on that briefly. The newer the condos, the cheaper the reserve funds. I know of a particular project right now that is right in front of me. The condo fees is around $100 and something, right? The newer the condo projects, the cheaper the condominium fees, which will take us to how old the condos are. The older the condos, the more reserve funds you will require, because you're looking at how old the property is, the materials that were used to build the condos as at then. Some of them, those materials are even outdated. So it requires a lot of funds to maintain older condos versus newer condos. So you should also consider how old that condominium is.
Thank you, Ian. That makes a lot of sense. So if the reserve fund is $1 million, then that's good. Well, I would expect that to be good. If the unit is maybe under 200 units, I think it's $1 million is a lot. I would expect that condo to be an older condo. Yes. And Sophia, I know the condo you're talking about.
And also the lawyers also will really advise you on this once they are reviewing the status certificate. So that's why it's also very imperative that you have the lawyers take a look at your status certificate before you go ahead with a purchase. Thank you.
And also for anyone that purchased like a newer condo, if you check the status certificate and it doesn't have anything reserved, it doesn't mean that it's bad. It takes time for those funds to accumulate, right? So when they're just starting out, people will just start to contribute maintenance fee. And if it's brand new, it takes time for them to actually need that reserve fund. So it takes time for it to accumulate. But when you have an older condo, you expect that they should have enough reserve funds to be able to take care of things because they've been collecting maintenance fee forever, right? So it's a good sign that they are setting some money aside into the reserve funds.
Awesome. Do we have any other
I
questions?
think it's a follow-up question. It is easier to qualify for a mortgage if you have 20% down. Mark, that's for you.
So Sophie, absolutely it is. And it's not so much easier from the perspective of a lower qualification. It's easier from the perspective of you have more options. When you're putting down less than 20%, you only can use your taxable income, which means your notice of assessment, or if you're a business owner, your net income after expenses. If you have 20% down, you just have a more multitude of options. You can go A, B, private. It really doesn't matter. As long as you have the equity in the property, you can always find a solution. So it also allows you to overcome credit challenges, as I mentioned prior. If you have less than 20% down, you have to have clean credit, no blemishes, nothing that we can't justify. And honestly, it's less about the score. It's more about why and the story. Like if you're traveling, you've gone back home, you forgot about paying a credit card, that makes sense. But if there's a history, there's an ongoing trend, perhaps you haven't traveled, you've just been sitting around and you missed something because of absent-mindedness, that's a lot harder to justify than someone that we know was traveling or perhaps was dealing with a family emergency. It's really about the story. And that's why your mortgage broker is so important, because I often have families say, hey, Mac, is it okay if I tell you this? Are you going to hold it against me or am I going to tell the bank? My job is to make you look as good as possible on paper. So we're going to prepare ourselves and present a story that makes you qualifiable in the eyes of the lender. We're not going to fib. We're just going to tell the best of the story and how we've worked and overcome solutions or overcome past challenges with current solutions. Okay. Looks like we got another one here, Nigel.
Thank you for the question, Sophie. I
Yeah.
think JP's question is for you, Mark. The next one.
Yeah. I have a client who inherited a condo from her mother who passed away. Trying to decide. Probably that would be like a one-on-one conversation that we want to have, Nigel. That sounds very personal and private. So let's wait to do that on a one-on-one after. Are there different type of townhouse within our maintenance fees? I could probably do that one. Yeah, there's two. So there's condo and there's freehold. Freehold simply means there's no condo fees. Keep in mind though, everybody wants a freehold because of no condo fees. So the home value will appreciate faster. There'll be more demand. But then in the contrary, the roof, the windows, all the stuff the condo fee would have taken care of is on you. So make sure you're saving every month. Don't come to find out you need new doors, windows, and a roof, and you've got no money in your reserves.
Richard, Mark, can you confirm if you took JP's question? Was sent around 7:10. Can you confirm if you took that question, please?
No, he didn't.
Did I? What was that? Oh, it's 7:10. Okay, let me go back up.
No.
7:10. 7:10.
Okay, I have a house and I have a locked-in interest rate. Oh, yes, I did miss that. I have a house and a locked-in for a high interest rate. With the lower interest, is it viable to refinance and benefit the? So what we want to do, JP, is we want to understand what lender you're with, and we want to do some research on what the penalty is. It has everything to do with the cost to break the mortgages. I actually do a due diligence for all the families that I help on a quarterly basis where we go back to look at where the market is and if it makes sense to pay a penalty. Sometimes you can still save even though you paid a penalty. Let me just give you an example. Let's say the penalty on your mortgage is $2,000 or $3,000, but it's going to save us $500 a month. I would say to you, hey, guess what? We pay a penalty. We save $500 a month. It's going to break even in 6 months. Does it make sense for us to pay the penalty, claw back the penalty over 6 months, and then for the next 2 or 3 years be in that lower rate environment? it does. It makes sense to do that. If you find that if we pay the penalty, it takes 3, 4, 5 years to make it back, then that's not something that makes financial sense. Allow the numbers to guide the decision making, not emotion and not the Globe and Mail telling you to, pay a penalty or to get back in at a lower rate. I hope that makes sense, JP. Lots of questions. That's great. I think we went over that. I have a yes, thank you, Nigel. If I don't have 5 or 20% and my credit score is bad, how can you help me get a house? Okay. So the first thing that I would do for you, Favor Justice, is I would want to say we need to get you involved and connected with our financial planner. They are going to complimentary give you a financial plan that allows you to increase your credit score and to actually put a financial plan down on paper that makes sense to begin further to your savings. Often you need 2 to 4 years to save for a down payment. So if you're not in a position to buy a home right now, don't discount or think that you've done anything wrong. You just haven't had a system in place long enough for you to be able to accumulate the funds. So if you want to have a referral to a financial planner we work with, someone that you can trust, that we referred to other clients in the past, I would say that's step one. Get a financial plan down on paper so you know exactly what you're working towards. Okay. Oh, and then Nigel's a realtor. Okay, so yeah, Nigel, let's have a call after the fact and see how I can best assist you there. This might have to be one of the last questions. So, Sophie, do you recommend a fixed or a variable? There's honestly no one right answer for that. It has everything to do with what your 3 and 5 year goals are. Is this going to be your forever home? Do you plan on buying and selling in the future? What's your risk appetite? Are you someone who would lose sleep if the rates went up? Are you someone who's okay with a bit of flexibility and a roller coaster, knowing that there's savings there? These are some of the questions that I would want to ask you and allow you to tell me if you want a fixed or a variable. Once I know more about your family dynamic, I can make some suggestions, but it's not as cut and dry to say fixed or variable. It's really like 20 questions on what's most important to Sophie and her family around deciding which direction to go. Yeah, perfect.
Richard, would you like to touch on JP has another question with regards to the different types of different types of townhouse.
I think Mark touched on it already.
Yeah, I think I went over that really, really quickly.
Okay.
Okay, awesome, folks. Please, please, please follow us on social media. We both are very active on Instagram and Facebook. You're going to get daily content updated for me on the mortgage industry, obviously, and Richard and his team from anything real estate related. You utilize us, use us, ask us questions, connect with us, DM, give us a call. We'd be more than happy to be a part of your future real estate plans.
All right, thank you, Mark, for joining. I know we had to pull you hard for you to be able to do this for us, and Enyi actually facilitated this. Thank you, Enyi, for for making the matchmaking a couple of months ago. Thank you, everyone that joined today. It's evening. I'm sure it's after work for taking time to join us today. But what I will actually invite you to do is, if you join through a direct link, we have the whole session recorded for you to send to you tomorrow morning. Please kindly drop your email or reach out to whoever sent you the link. They're going to send the recording to you. If whoever sends you the link is part of the group, you don't have to send your email. They will send you the recording. But if you just join through direct link and you can attach it to anyone, please drop your email. We have it sent to you, and you can always take time to watch it and also forward it to friends and family that can actually benefit from it. Mark is a mortgage broker. We've been working together for quite a while now. We've only gotten positive feedback from all our clients. If you have any real estate needs, mortgage needs. Sorry, guys, I'm used to real estate. If you have any mortgage needs, and you don't have to be at the point of trying to buy, even if it's just questions or preparing yourself to get a mortgage. The thing is, it's always good for you to have a plan and know what you're working towards. In terms of mortgage, we make mistakes. We are open to making mistakes every day, right? How we spend, how we use our credit card, how we can say reach out to Mark so he can prep you. It could be 4 months, 3 months, 6 months down the line, but it's good for you to know what you're working towards. And guys, it's the beginning of the year. It's good to always take advantage from now. So by the end of 2025, you'll probably so you can spend the Thanksgiving, Christmas in your home, right? So reach out to Mark. His details is there, his phone number, his email, and his Instagram and Facebook.
Hey, Evelyn.
Oh, okay. Inspector Mando, but when it comes to real estate, you probably know one of us on this group, whether it's Enyi or it's myself or it's Newton or it's Darlington or it's Sylvia, reach out to us and we'll love to help you and we can always reconnect you back to the mortgage broker when needed. Okay. Okay. Chioma said, thank you, very educative webinar. Thank you so much. Then yeah, sorry. So we just take on all these emails. Again, reach out to whoever sent you the link as well. They will send you the recording. And please do not hesitate to send it to your friends and family, anybody that you know will benefit from this powerful session.
Amazing.
Okay, that brings me to the close. Does anybody have any
One
input?
sec. Yeah, just before we wrap up, I just want to first thank everyone for also coming. But I also want to mention to everyone that what we've done for 2025 is to have trainings, webinars, info sessions like this every month. So please oblige us to send you information in regards to upcoming trainings, webinars that we're going to be having going forward. We will definitely be having something every month. So it can be info sessions, webinars like this, or even in-person events. So expect messages from us, emails from us, and we just want to thank you for making our time to attend this webinar. Thank you so much. Have a wonderful evening, everyone.
Okay, thank you. We have other member of the team. We have Newton, we have Darlington as well. We have Sylvia. So please do reach out to them for the recording. They're going to send it to you, or if you want to take this conversation forward. And also they will always connect you back to Mark what you did. Okay. Thank you everyone for joining. It's a pleasure to have you on today to spend almost an hour and a half with us. And it's just a good sign. We still keep the numbers strong, 41 people. It's just a sign that you'll find it powerful. Like Anyi said, look forward to our emails. We're going to send the recording and the upcoming webinars. And we're super excited for you for what is about to happen and you becoming a homeowner in 2025 or whether it's 2026. We're rooting for you. Thank you, everyone.
Bye.
Bye.